Most of us have encountered credit and debt at some point in our lives. You may be someone who has taken out a loan to pay for college, or you may have used your credit card to purchase the latest iPhone 14. Hey, at least you didn't have to sell your kidney. While credit creates buying power and gives you the luxury to buy something now and pay for it later, it also creates debt, which must be repaid. The question of whether credit and debt is a good or bad thing hinges on what that credit produces and how the debt is repaid. It's easy to get excited when you're financing that car that you always wanted, or a house, or getting a loan to start a business, but the reality always sets in when the bill comes due and it's time to repay the loan. Financially responsible people don't like holding too much debt, but they know how to leverage it, and if handled responsibly, it could offer a lot of advantages. For example, credit provided to finance a housing development that will generate sufficient income to service the debt and create a return on investment is considered good debt and is beneficial for the economy. On the other hand, getting credit for financing something that will have little to no productive output might not be the best allocation of resources. In a debt-based economy, which we're in, credit and debt that produces enough economic benefit to pay for itself is a good thing and is essential for economic prosperity. What happens when access to credit is too tight or borrowing costs become too high? Consumers and businesses alike will be negatively affected. Even though it may seem that having strict lending standards will lead to fewer debt problems, it also slows down development and innovation. On the other hand, though having lax lending standards may lead to more growth, it also increases the chances of an economic bubble and debt problems, and the trade-off may not be worth it. This is where the Federal Reserve comes in, whose responsibility is to find that perfect balance. One of their main goals is to ensure economic stability through monetary policy, to avoid economic growth that may spiral into a bubble and high inflation, or economic slowdown that may lead to depression. One of the tools the Federal Reserve has in its arsenal and uses to create an economic balance is interest rates. In today's video, we will discuss how rising interest rates affect you as a consumer and also how it affects businesses. Welcome back, guys. My name is Vitaly with another attempt to give you a little context of today's economy. If you find this helpful, please don't forget to share the love by smashing the like and subscribe button. You've been hearing it on the news a lot lately. The Fed is set to raise the interest rates by another 75 basis points, which they just did a few days ago. If you think Fed's aggressive rate hike campaign only affects Wall Street or those who are wealthy, don't be so quick to dismiss what the Fed is up to. You may be surprised to learn, but their policies affect you more than the wealthy. In fact, the middle class is always the one that's most impacted by the Fed's policies. For example, the Federal Open Market Committee holds 8 policy meetings every year, during which they survey the economic landscape and vote on whether to hold the federal funds steady or change the rates. When you hear that the Fed is raising the interest rates, they are increasing the federal funds rate. This is the rate at which commercial banks borrow and lend their excess reserves to each other overnight. Here's how it works. When you as a customer and a million other customers deposit money into your bank account, those deposits provide banks with capital needed to issue loans and other forms of credit to other customers. Yes, the banks take the money you deposit, slaps an interest on it, and lends it to others. That's how banks make their money. However, regulators require that banks keep a certain percentage of their total capital in reserve to guarantee their stability and solvency, just in case too many people would want to withdraw their money all at once. Since the amount of capital held by banks constantly fluctuates as deposits are added, withdrawn, or lent, banks often need to borrow money from other financial institutions overnight to meet regulators' reserve requirements. Again, the federal funds rate is the benchmark interest rate banks charge to lend each other money, which reflects on the rates they charge you and their other customers. At the beginning of 2022, the Fed funds rate was at near 0%. Today, it sits at 3% to 3.25%. When borrowing costs increase for banks, banks pass those higher borrowing costs by raising the rates they charge for consumer loans. If you are a credit card debt holder, the higher the rates, the more expensive it is to carry that debt. The same goes for people with adjustable rate mortgages. If the Fed raises rates, your monthly mortgage payment will go up. Fixed mortgage rates, on the other hand, are not directly impacted by a Fed rate hike, but it does influence them. The Federal Reserve does not set the mortgage rates. Longer-term mortgage rates are more influenced by the 10-year Treasury note yield. When the yield rises, so do rates. The 10-year US Treasury yield has been considered a benchmark for mortgage rates and generally move together. As a fixed-rate asset, mortgage-backed securities are always in competition with Treasury instruments for investor money. For mortgage rates to stay competitive, the mortgage rates inherently follow changes in Treasury yields. Treasury notes are generally considered a safe investment because the government guarantees them from default. Therefore, any other debt security that carries a higher risk must offer a higher yield to attract investors. In this chart, we can see how the 10-year Treasury yield and the 30-year fixed-rate mortgage move hand in hand together. As you can see, the Federal Reserve's policies do have an impact on your everyday life, whether it's through the interest rates you pay on your loan or the prices for goods and services. The Fed's main goal is to promote maximum employment and price stability in the economy. While they often use different tools to achieve these goals, interest interest rate changes are one of their primary levers. So next time the Fed announces changes in rates, take a moment to think about how it might affect you and your wallet. If you are a business owner, a Fed rate hike also affects you in many ways. For one, it makes it more expensive for your business to borrow money. If you have a variable rate loan or line of credit such as small business credit cards or an adjustable mortgage rate on your commercial property, the higher the Fed funds rate is, the higher your interest payment will be. In addition, if you own a bond portfolio or other investments that pay fixed interest rates, rising rates means that newly issued bonds will offer higher yields than those currently in your portfolio. This will cause the value of your bonds to decline as investors shift their money into newer, higher yielding bonds. As a business owner, you should always be aware of how Fed rate hikes can affect your business and take necessary precautions to mitigate risk. As of today, the Fed is determined to curb inflation, reiterating that more rate hikes will come and is forecasting rates to reach 4.6% in 2023. This without a doubt will cause more pain in the economy, and the Fed might finally say the R word out loud. While the Fed remains hawkish in battling inflation, some argue that going forward, economic pain will be so great that it's only a matter of time before the Fed starts quantitative easing again. That's all I got for you today, and if you made it to the end, thank you for your time. Take care, and until the next one.